What's up, everyone? It's Scotty with MoneyVest. So in this video, we are going to be talking about the most important Fed meeting that's coming up on Wednesday. So tomorrow at 2 p.m. Eastern, we're going to get the statement from Jerome Powell and Monetary Policy Committee, the FOMC. I'm going to break that down. I will be live during that time. And at 2:30 p.m. Eastern, 30 minutes later, we've got the very, very important Fed chair speech from Jerome Powell. So this is the Monetary Policy Committee. The meeting actually starts today. It's a 2-day meeting. And of course, tomorrow they are going to release both the statement and the press conference, which will take place at 2:30 p.m. Eastern, like I said. And that's going to very much, move the markets, right? I mean, this is a market moving event. It's always been. And in this video, I want to go over exactly what the expectations are right now. And I also want to talk about some of the expectations for what Jerome Powell may or may not say, how that might be perceived by the market, and whether that's going to be bullish, bearish, neutral, going into tomorrow's price action, and of course, what it's going to take to see some rate cuts later, either this year or next year. So hope you guys enjoyed this video and find it helpful. Make sure that you drop a like and don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. There's a 16% annual discount that's available until tonight. So after tonight, midnight, that discount will go away. And we've also got educational courses, fundamental and technical analysis, as well as options course, currently 50 to 60% off. And the coupon code is going to be Halloween. So that's only available also until tonight. After midnight, it is going to expire. So links are going to be down below, and we'd love to have you on board. So this right here is the big decision, right, for Jerome Powell. No rate hike versus a 25 basis point rate hike. Now, I think the expectations and of course the consensus right now is on no rate hikes, which I also believe is going to happen. So you can see that this is where the meeting probabilities are for today. About a 98% probability that tomorrow the Federal Reserve does not change interest rates. Basically keeps them steady at 5.25 to 5.5%. And majority of the market consensus and most expectations are that we are done with the rate hikes, and we're going to see 3 rate cuts in 2024 towards the back half of 2024. Now, we know that Jerome Powell and the Fed in their previous summary of economic projections pointed to one more potential rate hike, and something that Jerome Powell also said in the meeting that we are prepared to do more if we need to. And of course, that's keeping the door open for another 25 basis points. And I think that's exactly going to be what Jerome Powell ends up saying tomorrow as well. I think it's going to be that we're data dependent. That's kind of like the same script and what we have heard from Jerome Powell, but once again, sounding somewhat hawkish to make sure that the market understands and knows that they are okay and ready to do more if required. Couple things here. Number one, I think the 10-year yield has done some of the work for the Federal Reserve, because as the 10-year yield has continued to move higher since June, July, we have seen significant increase in mortgage rates, personal loan rates, business borrowing, right, commercial lending, and of course, not to mention credit card debt, credit card loans, and interest rates on that loan, and of course, auto loans. Everything has pushed higher, which is now making the economy super tight from a credit standpoint. So they have certainly done some of the work through the yields, which the market has pushed higher. And the second thing is that, of course, the cuts, the Federal Reserve has priced in, or pretty much told us 4 rate cuts next year, and the market's pricing in 3 right now. And the timing of those rate cuts is also very, very up in the air, right? We don't know exactly when those cuts are going to begin, but of course, a lot of it is going to be dependent on what happens in the economy, right? There could be no cuts next year if certain things happen. For example, if inflation continues to stay high, the economy continues to stay strong, as we have seen the GDP numbers, 4.9% growth. We've got the unemployment numbers coming out this Friday, but jobless claims not really pushing past 200,000. They're still very, very low. So it's a possibility that rate cuts may or may not happen. But the language that I want you guys to follow really is going to be from Jerome Powell, which is going to be somewhere over here. This is what I really want to help you guys keep track of. So, for example, when it comes to the rate decision, we know that rate hike is unexpected. No hike is the expected outcome for tomorrow. There's over a 98% probability, as I showed you guys in the previous slide. So no hike expected, and that's going to be a very, very neutral move from Fed and from Jerome Powell, and it's not going to be a very significant market moving event. What's going to matter more is what the Federal Reserve is planning to do, right? Because the interesting thing is the Federal Reserve's objective and the goal is not to bring inflation down, right? It's for them to keep inflation down. I think that's where the miscommunications happening from the media and from Jerome Powell and the Fed, because media constantly, is forcing the Fed, or at least is putting their views out, saying that the Federal Reserve is tightening too much and they need to bring interest rates down, right? So we've heard from Jamie Dimon, we've heard from Jeremy Siegel, we've heard from Kathy Wood saying that, the Federal Reserve, is tightening too much. They need to bring interest rates down because inflation is back lower. Well, that's not the goal, right? Unfortunately, I think this is what Jerome Powell needs to make very clear, is that the goal isn't to bring inflation down. It is to make sure that inflation stays down and doesn't go back higher, because the moment they start cutting, there is going to trigger that quantitative easing cycle. Once again, it's just part of the process. The moment they start cutting, that is QE, right? That's part of quantitative easing. And that's going to stimulate the economy. That's going to stimulate growth. That's going to stimulate spending and borrowing even further. And that risks reigniting inflation back up. So that's something I think Jerome Powell needs to make himself very clear on, that the goal isn't to bring inflation down. It is to keep inflation down for a longer period of time and keep it under 2%. Now, this right here, again, we are expected, right? So neutral market event. Now, when it comes to guidance for this year, right? So one rate hike is still expected from Jerome Powell and the Fed. That's what they've penciled in the summary of economic projections. So I do believe that is going to be very, very neutral. Now, we don't have an SCP coming out tomorrow, but this is specifically to the comments, right? So if anything relates to comments related to like one rate hike expected, we're going to leave the door open for potentially one more hike later this year, or we're going to be data driven and we are going to be doing more, then I think that's the market's expectation. That's exactly what the Federal Reserve has told us in their previous summary of economic projections. So I think it's going to be very, very neutral. Now, if we hear anything Jerome Powell talks about that suggests even remotely that there's a possibility for maybe 2 rate hikes this year. Again, he's not going to explicitly go out and say that. I don't think he will. But anything that kind of remotely suggested that 2 rate hikes is possible, then that would be unexpected. And it's possible that we do see that as a bearish move for the market, and we start to see it, kind of market starting to kind of pull back a little bit, and that acceleration, to the downside. Now, anything that Jerome Powell says that kind of suggests 0 rate hikes or 1 rate cut possibly would obviously be very, very bullish for the market. And this is only for 2023. And now we get into 2024. And I think this is really what the market's going to be more focused on going into next year. And the only bearish outcome for the markets tomorrow from Jerome Powell's speech is going to be anything that suggests there's going to be 1 or more rate hikes in 2024, or fewer than 4 rate cuts in 2024, because both of these are going to be somewhat unexpected, right? Because 1 or more rate hikes, nobody's expecting rate hikes in 24. We're just pretty much expecting to be done this year. And for next year, we're expecting rate cuts, right? At least 4 is what Jerome Powell and Federal Reserve has penciled in their SCP. 3 is what the market's pricing in. So I guess I should put anything that's less than 3, right? So anything that's less than 3 rate cuts in 2024. Actually, I'm just going to quickly double check here. So we're going to go over to Federal Reserve's monetary policy. So we're going to go to that website and just take a look at the summary of economic projections from last meeting, because I'm pretty sure I think they already did cut their guidance for the rate cuts in 2024. So so there we go. So federal funds rate, expectations for 2024, they're already down from 5.6 to 5.1%. So that's about a 50 basis point. So they've already got it to 2 cuts. So I should actually change that, not 4, but it should be anything fewer than 2 cuts. So this is not 4. Just want to be very clear. This is basically 2. Anything that's fewer than 2 cuts, I think, is what the market's not going to like. If there's anything that Jerome Powell says or suggests, or in a way kind of mentions that, fewer than 2 cuts, then that I think is going to be bearish for the market, which obviously is not going to be great. But of course, if we do see 3 or 4 rate cuts, then the market's expecting at least 3. So that's going to be very, very neutral. So in other words, very neutral. And this needs to change as well. Anything that's over 4 or more rate cuts will be very bullish. So this will actually be both bullish. Both of these scenarios will be bullish. Anything that's over 4 rate cuts, I think is going to be bullish for the market. And again, these are not things that we will get all the information from Jerome Powell tomorrow. But these are just things that we may have to kind of figure out, okay, what is he saying? What does he mean? It's kind of kind of reading between the lines, basically, because Jerome Powell is very, very vague sometimes. Now, this right here is going to be, in my opinion, what it's going to take for the Federal Reserve and Jerome Powell to cut rates, right? Rate cuts will happen. And markets will rally when jobless claims starts to go higher, unemployed persons starts to go up, and GDP starts to come down as well. In my opinion, I think these are some of the reasons very, very important for the economy to show, because that's what the Fed has told us, that they need to see some weakness or softening in the labor market. And that's basically in support of these goals, in support of these monetary policy goals and economic growth and unemployment staying steady, is where the rate cuts come into the equation. Or there's a possibility that we see inflation, core inflation more specifically, come down to under 2%, or if there's any type of potential crises or political pressure, because there's an election year next year in 2024, which obviously could put more pressure on the Fed as part of their monetary policy to cut interest rates, because higher interest rate environment definitely does squeeze out everybody, and it makes the credit conditions very, very tight, thereby affecting, of course, the political parties, whoever's in charge or whoever's trying to win, put more pressure on monetary policy to cut interest rates. But again, we're not going to talk about politics, but anyway, so talking a little bit about where we are with risk tide versus risk-free premiums, and in terms of market opportunity, everything's an opportunity cost in the market, because you're giving up the capital to invest in XYZ to basically invest in something else. And if you take a look at S&P 500's dividend yield, earnings yield, and the real estate cap right now that we're looking at, it has diminished over time in the last 8 years, because in 2015, we had a dividend yield in the S&P of over 2%, earnings yield was over 5.6%, and the real estate cap just under 6%, when the treasuries, which is the risk-free rate, was sitting at just under 0.2%, which is really, really low. So there was a significant premium, a risk premium, for investing in equities and real estate as opposed to investing in treasuries, which are bonds. Now, if fast forward 8 years later, you'll notice in 2023, we're now sitting at 1.5% dividend yield for the S&P, 5.2% earnings yield, and just under 5% real estate cap, while also the treasuries are sitting at well over 5% at the moment. So the bond market, again, on a risk-adjusted basis, definitely is a lot more attractive compared to equities or real estate. So that risk premium has diminished over time. Now, the market has not realized that yet, because for some reason, investors still want to own equities, especially institutional funds and hedge funds. They're still more geared towards equities and real estate as opposed to treasuries. But I do think that that is mostly because they believe the yields are going to go higher, and they're just waiting for that top to get hit. And the moment it starts to kind of roll over, there will be an influx of liquidity flowing into treasuries and bond market, because they want to lock in those rates for the next 3 years, 5 years, 7 years, 10 years out. These are very, very attractive rates, by the way. We haven't seen yields as high as they are in over 16, 20 years. So needless to say that these are very attractive levels for treasuries, which has still not been able to attract as much liquidity as you'd imagine. But that's where we are with the Federal Reserve. So hope you guys enjoyed this video and found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. And of course, link to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the members-only benefits and trading view charts and intrinsic value spreadsheets, stock reports. Everything's going to be available with that 16% annual discount. Don't forget fundamental and technical analysis courses, as well as the options course, available up to 50 to 60% off. Link's going to be down below. As always, happy investing. I'll see you all in the next video.